the market clearly doesn't like it. So keep that in mind. Okay, back next 20 minutes of the show as well. We'll probably hear PM Modi speak as well. But we've got a very big market voice, or a very big voice per se, global voice. Geopolitical uncertainties looming around us in 2026. Robert O'Leary, popularly known as Bob, of course, Co-Chief Executive Officer and Portfolio Manager at Oaktree Capital Management, believes that sectoral churn is on the cards, and don't get married to one particular idea and ideology. Listen into a small slice of the conversation that I had with Bob. I would love to understand from you, Bob, as you look at the world from your vantage point, if people in 2024 thought that it was a year of peak volatility, 2025 really came in as a bolt of surprise. And if people thought that 2025, starting from deep sea to Russia, Ukraine, to multiple other geopolitical and political events, might be peak of volatility, boy, 2026 has started off on a strong footing too on that note. How do you see the world from your vantage point?
Yeah, we very much agree that volatility has increased over the last several years. I'd go back to a memo that our founder, Howard Marks, wrote back in December of 22, which he entitled Sea Change. And I reference this quite a bit because I think it's very accurate in how it describes the macroeconomic environment. And what that memo says, in essence, is that a lot of the forces that drove sort of unprecedented level of prosperity and financial market sort of health over the last 40 years was starting to come to an end. And really the three forces that drove that were increasing population, globalization, and geopolitical calm. And as we sit today, all three of those forces have been disrupted. Certainly geopolitical calm, we don't have that. You're starting to see deglobalization instead of globalization. And then finally, you're starting to see population be a headwind instead of a tailwind. And the implications for the economy are really quite profound. Those three forces drove unprecedented declines in interest rates and very calm interest rates over that 40-year period of time. And I think what we can expect from here on out is much more volatility. And in fact, since that memo was written, that's exactly what you've seen. You've seen higher and more volatile interest rates, even with central bank rates declining in the last 18 months. Long-term rates have stayed high, and we anticipate that to be the case. So yes, we think the backdrop has become much more volatile, and we expect that to persist.
How does a large institution decide between asset classes and make investment decisions in such volatile times, especially since tariffs are actually adding further fuel to fire, because it's no longer tariffs from the United States to a select band of countries. It now seems to be the world seems to be tariffed by the United States, right? So there are tariff tensions, trade tensions, and of course, as we said, heightened volatility. How do you guys think about investing or make investing decisions in such a scenario?
It's something that we think about on a daily basis. And you're right, tariffs are going up all over the world. That's the surest sign of the deglobalization I referred to just a moment ago. And that will make for higher and more volatile interest rates, which should transfer value from equity holders to creditors in the coming years. We at Oaktree specialize in fixed income, primarily sub-investment grade fixed income. And I think that plays very much to our strengths. So part of the question, or the answer to the question that you asked, is in what we do on a daily basis, which is that we very much focus on the credit side of the equation. Within that, where we do our best work, or where I believe we do our best work, is in dislocations, environments where syndicated markets start to break down, and it requires alternative capital of the form that we have to step in and provide that capital to borrowers. We're starting to see that with increased frequency. There has been, at a surface level, a level of calm and relatively benign market conditions. But if you look below that, it's starting to show some deterioration in terms of credit conditions, and we think that persists and perhaps increases over the course of 2026.
Wow, Bob, sorry, just trying to understand this. Would you believe, or are you trying to say that what will triumph in 2026 and 2027 maybe is fixed capital which is available on tap, fixed income which is available on tap, or could it be opportunistic fixed return capital like private credit, for example, which will be able to make the most of such times?
So I think it depends a little on the path of the economy and of the financial markets. If we see a recession, which I think is entirely possible, there's really only one thing propping up most of the global economy at this point, and it's spending on generative AI. If that were to deteriorate or somehow start to decline, I think you would see a recession. And if there's a recession, we'll have a very significant opportunity in opportunistic credit. If it stays largely where it is, the economy that is, and the financial markets as a resulting matter don't see a major dislocation, I still think the place to really focus is credit. It will be in different forms of credit, more performing credit. To your point, it could be direct lending, where we're going out to approach borrowers on a bilateral basis instead of through the syndicated markets. But again, it depends a bit on the path of the economy from here.
But you do believe that equities, which had a great run, and led by U.S. equities in 2023 and 24, and even if 2025 U.S. equities were not top of the pile, but they certainly did perform. So 3 years of a return, high return generating equity return in the U.S. and some other areas, you reckon equities might not be the asset class of choice in 2026?
It is the collision of two profound, almost tectonic shifts in the global economy. On one side, again, generative AI. And if you look at the outperformance of the equity markets, it's those names that are associated most with generative AI that have seen their currency, their stock go up pretty meaningfully.
That's true.
And on the other side, this volatility that I mentioned a minute ago in interest rates. There's a battle between those two. Again, in the last 2 years, the economy has largely been dictated by the strength of generative AI and the spending associated with that. I think 2026 we could see a reversal there, where you start to see the volatility in the market start to overcome that. As people get worried about the return on that massive amount of spending that's gone into generative AI. And if that happens, I think equities could suffer as a result.
Wow. And Bob, do you reckon that this would, equities at major economies suffering in your terms as a result would mean that equities across the world have a bit of a lame or a lean 2026, or could some markets like India, for example, which have underperformed almost all of 2025, both relatively and absolutely, and have growth up ahead? India could well be one of the fastest growing economies with 6.5%, 7%, 7.5%, depending on which way you believe it will. But let's say, or when the numbers show up. But would economies like that have markets which are outperforming?
It's entirely possible, and I don't know the factors that drive a lot of different major economies. You mentioned India, and the growth and the strength in the economy here is astounding. And it is not as tied to generative AI as some of the other major economies. So it's entirely possible that you do see a decoupling of some form between what goes on in India or other markets and what you've seen in some of the developed markets. But I do feel like there's been one major force that's driven most of the major economies, and if that rolls over, I think you're going to see a lot of pain in the developed economy financial markets.
Very interesting. What do you think about the next 5-year cycle then? I mean, let's assume that what you're saying turns out to be true, in that we might, if we do see some bit of AI spend come off and there being a low growth or a recessionary phase, could this be a long-lasting one, considering that geopolitical stress is also quite high? Or could central banking decisions rev up growth? Because we know that post-2020, effectively central banks decided, right, what money supply and growth could be like. And even though 2026 might see conflicting decisions between major central banks, could they still hold the trump card? Pun is not intended here, by the way. Yeah,
interesting. Good pun. So stepping back for just a minute, well, I did indicate, and I still believe, that there may be some short-term disappointment in generative AI and the tremendous, just staggering amounts of capital that have gone into it. In the long term, it is a transformative technology on the order of which we haven't seen in my lifetime. The biggest comparison is back to the .com, the development of the internet and everything associated with that. There was, of course, a very punctuated crash in the markets associated with the internet, the development of the internet, but the economy recovered very quickly. And ultimately, it was a tremendous boon to productivity, and that provided us a lot of stimulus over the ensuing 2 decades. I think you'll see much the same progression here. If there is a disappointment, I think it'll last for a period of time, not probably more than a year or two, and at which point you'll start to see the use cases for generative AI start to really get traction and increase productivity at a level, again, that I'm not sure we've seen in my lifetime. So I am long-term optimistic, but I think there could be a wobble, or as we call it, a dislocation at some point in time when it's sort of determined that the returns on the early spending might not be as nearby as people think.